Welcome, everyone. Thank you, Ion. Let's get the comments up here. I did what I was supposed to do on Instagram. What else? I got my notes. We're live on Facebook, LinkedIn, YouTube, X, Instagram. Sound is good on Facebook. Thank you for that, Ashley. Oh, I know what I could do. I could take this banner off here. Let's get rid of that. And I think we're good to go. Let's just give people a few minutes here to join in. I'm going to be self-indulgent. Are you okay if I'm self-indulgent? Normally, my content, I try to make it about you. I'm going to talk about me for a second. This is the Week in Review. And in this week, I took 2 days off, which I never do in the middle of the week, or rarely do in the middle of the week, because it was my daughter's. She became a teenager. She turned 13, and she's been planning her 13th birthday party since she was 8. And part of this is my fault, I'm certain, in the upbringing, but she wanted to do a city experience. We live on a mountain in the middle of nowhere. And so bottom line is this week I took 5 13-year-old girls to Calgary, which is about 3.5 hours drive for me. And they got a suite for the night in a hotel room on their own. So I was in the hotel, but in a different room, obviously, and not even on the same floor. They got a suite for the night. My daughter wanted to have dinner at Modern Steakhouse in Calgary, which is a fantastic restaurant. It's one of my go-to places. And they just I sat at the bar in a different part of the restaurant. And the Modern Steakhouse people looked after them so well. And they ate. Sometimes we take kids out for a fancy dinner like that. They don't really eat, but they had a caviar service. They had appetizers. That's the caviar's, the my fault part for a 13-year-old. She loves caviar, and so do her friends now as a result. But they had a caviar service. They had appetizers. They had steak. They had crazy desserts. The Modern Steakhouse people were just bringing out dessert after dessert, a sampling of everything, mocktails. It was a fantastic night. And they, there was this issue about how do you get 5 13-year-old girls, so plus me. So there's 6 people in Calgary. I don't want to drive. You can't park near that restaurant. I'm going to have a couple of drinks while I wait for them probably. So I don't want to drive. Normally I would just Uber, but in Calgary, unlike Toronto or New York or Miami, you can order a Suburban or a Escalade or something large, and you have a bunch of seats. Thanks for joining, everybody. I'm just telling a quick story that is self-indulgent while we wait for people to join us, and then we will get rolling. And so but in Calgary, if you're on Uber, you don't really get to choose what it is. So they're gonna show up in a Tesla, and it's gonna seat 2 people, and you can't call multiple Ubers. And I didn't want to walk. It's a sketchy hotel area, this hotel. And so we got a limo. So they had a stretch limo for 12, and it was the whole. You go inside and there's a disco thing going on. The girls freaked out. Anyways, next day they went, they did a shopping spree in a mall on their own. So what a trip. So that was 2 days out of my week. And that has given people an opportunity to join us. So let's get started here. Welcome to a Week in Review at Sinclair Range. And I know we haven't been doing it every week. It seems to be turning into a month in review, but that's how busy we are here with the turnaround plan, the rebuilding of Sinclair Range that I introduced, I don't know, maybe mid last year sometime, is going so well that it's hard for me to keep up with the shows. My name is Scott Sinclair. I'm founder and president and owner of Sinclair Range. And the mission here is to just bring you on the journey, to give you some insight into the ongoings, what's happening inside Sinclair Range, your window into decisions, day-to-day business adventures. And we try to break the show up into segments like a lesson of the week, interesting file, deal of the week, struggle of the week, of which we have none to talk about this week, unusually, my observations and musings of the week. And so it's all, that's what we do. And I just need to check. Hey, thank you for joining us on Instagram there, Robert. Good to see you. Let me go back to this screen here. And so let's get rolling. Sinclair Range has been working with a number lately of small pools of capital. This is really a more distinct business line for us in 26, late 25. And so high net worth individuals, family offices are saying, hey, Sinclair Range, here's a bunch of money. We're going to set this aside for you and bring us some deals, bring us some DIP loans, bring us some senior secured lending, usually all private credit stuff. And as part of our arrangement on some of those situations, we're put in a position, I don't mean to say that in a negative sense, but we're being asked to do financial work, financial advice on really, really small businesses that wouldn't typically fit into the mandate of Sinclair Range, just on a cost structure. Like these businesses just couldn't afford us, to be blunt about it. But because we have this broader relationship and we love these people and we love our clients and we're here to help out, that's part of our mandate. So we've been looking at smaller businesses indirectly, if I can put it that way. And this week, we had 2 small businesses that we were asked to provide guidance on with respect to value. What is the value? I need to buy out my partner, or I'm trying to sell to my partner. And we had 2 of those come to us literally this week, okay? And so I want to talk to you about this from 2 perspectives. One is from a professional process perspective, because I am a business valuator. I've been a chartered business valuator in my career and written tons of valuation reports and fairness opinions and all that sort of stuff. So I always think about it. And again, as the owner president of Sinclair Range, where I have to manage professional hours or at least allocate priorities for professionals and think about how we can charge for that versus what we're paying these professionals, and are we making a decent enough margin, all that sort of stuff. So I want to talk to you about the process of this valuation, plus actually, if you are a small business owner, which is part of the target of our content here at Sinclair Range and thescottsinclair.com, how the hell do you value these businesses anyways? Like what? Because everybody thinks their business is worth, particularly small business, worth way more than it is. So I want to talk about that. What do you do as a professional in business valuation when somebody who owns, let's call it the mom and pop shop, the corner store, the local garage, whatever the little business is, what do you do when somebody comes to you and says, hey, we want a business valuation because we want to buy out our partner, or we're trying to sell to our partner? Well, the first thing you need to do as a business valuator is you need to understand exactly the reason for the valuation. Am I on the buy side? Am I on the sell side? Am I providing guidance? Is this an independent opinion of value? Is this for family law? Like, is there a divorce going on? And so am I going to get dragged into court on this? Is it for tax purposes? Am I going to get dragged into court on that? As a business valuator, you need to understand those things. And then you need to make sure that your client understands exactly the work that you're going to do, because you're probably not going to provide an opinion, because that's really, really, really expensive. So you're probably going to provide some calculations, some comments, some sort of valuation letter, and you want to talk to your client and have a back and forth on that. And then what you need to do is receive years and years and years of historical financial information that makes some sense, and financial projections, because value is always prospective, it's forward-looking. And so, I hope that didn't hit the hit the audio for you as I'm playing with my mic here and hitting it. You need to look at forward-facing information as well, because that's where value is driven from. You need to analyze that information. You need to follow up with a bunch of questions. You need to ask about redundant assets. What is a redundant asset? It's like, okay, this business is generating so much in value, and that would come out to, say, $2 million based on forward-looking cash flows. But also, it owns this piece of real estate over here that it doesn't use in the business. That is redundant to the earnings of the business, and you need to sort of ship that out. And also, you need to look at normalizing entries on cash flow, because you can't just look at historical statements and say, okay, well, they're earning $500,000 a year or $1 million a year without doing normalizing entries, which is, for example, a common one you would find in a small business is they own the real estate, but they own it over here. So it's in a separate company. And they want to value the operating business, but they don't want to value the real estate because they want to hold on to that for their retirement plan or whatever. But the operating business isn't paying for the use of the real estate because it's related party, or it's paying, but it's not market value because it's related party. And so to value the operating business properly, you need to impute a market value costs for occupancy in there. Hopefully that makes sense to you. You need to talk about discounts. So there's all this sort of conversations you have to have with the client, and then you need to write all of that and you're thinking into a letter, a valuation letter, which we would call comments and calculations as opposed to opinion. Hey, this is not an opinion of our value. We haven't done the work, but based on the scope of review as detailed in this letter, here's our comments and our calculations with respect to the fair market value of your business, which is defined as follows. Okay, it's like that's basically what that letter is. It's 6 to 10 pages. 6 to 10 pages. It has a bunch of schedules. It has to be proofread. It has to be accurate. It has to make sense. It has to have appropriate protections and disclaimers. Like, we're not auditing your statements. We are providing comments and calculations based on the statements that you gave us, which may or may not be crap. Like, who the hell knows? And so that's what that letter is. And as a partner, if it's an accounting firm doing this, or as the president of the firm, you don't necessarily want to do that yourself. You want to get a junior to do it. And if you get a junior to do it, which is handy because it's a lower cost per hour, but also it helps to train your junior or manager or whatever the level is in the firm that you're running and is doing your valuation. So you get them to do it, then you need to review it, then you need to fix it because they did something wrong or that you don't agree with from a professional perspective. And so there's a bunch of editing back and forth. And in total, for one little small business, the corner store down the road, you're 15 to 30 hours of professional time to generate that sort of letter for a client. 15 to 30 hours. At say an average of $300 an hour, somewhere in that range, you're $4,500 to $9,000 in professional fees to do that letter, which is why these letters, when you go and get one priced, they're $5,000 to $10,000. That's what they are most of the time. There's lower than that. There's higher than that, depending on the quality and the cost structure of the firm that you go to for that valuation report. But, you know, they're $5,000 to $10,000. That's what it is. Now, I personally try to charge or recover about $1,200 an hour. And so for me to do that myself would be $18,000 to $36,000 on those numbered hours. Now, I would be a little bit quicker, probably, so more 15 to 25. But it's too much money. That's why, and no one's going to pay that, which is why we don't do much of that work anymore at Sinclair Range. Even our VP is, I think, 800, 850, somewhere in that range. Don't hold me to this. If you're an engagement letter with different numbers, don't hold me to this. I'm just talking off the top of my head here. You know, we don't do this work anymore, but we have a commitment to do that, as I explained at the beginning. And so, but we had to do it. So we're now using Claude AI. Do you use Claude AI? Are you on a journey as a small business owner, as a professional? Are you looking at different artificial intelligence platforms to do your work? I think I've talked about this on this show many times before. We started off at Sinclair Range at ChatGPT. Found it good for writing. Found it terrible at math initially. It evolved, it got better, and then it started devolving and got way, way worse. It's terrible right now. We canceled all of our subscriptions. We went through Gemini. We tried some other apps. And now I'm using Claude AI a lot. And their co-work feature is fantastic. So we use Grok, XAI for research. Hey, what's going on with this? What's going on with that? And I use Claude AI and Workspace in particular for everything else day to day, where I'm on it all day long. And it is fantastic for work. So what you can do in this shared workspace is you can give it access to a folder on your hard drive. And you can say, hey, here's everything I received from the corner store down the road, their financial statements, their budgets, their projections, their all material contracts. Take a look at that and generate a reporting letter for me on valuation. Then it comes back and it asks you a couple of questions. And a couple of questions relate to, you know, relevant things. And you have to know what you're doing. You have to be able to answer the questions and give it guidance as to what you're looking for, which as a professional business valuator, I am able to do, obviously. But here's the bottom line. This AI I did two valuation letters written out, full schedules, math correct, standards, valuation standards, definitions, working and conclusions, all of the disclaimers and all that sort of stuff. Written as well as I would normally write it myself. Written as well. And it took me 90 minutes for both. like less than an hour for each one, which would have been 15 to 30 professional hours per without the use of artificial intelligence. It is insane how good that is. And it fact checks fine. What you're worried about is that the fact checking is not going to work out and it's just made up stuff. Nope. The fact checking was perfect. In fact, one of these clients, their accounting firm had done a discounted cash flow for one of these companies, and it had mathematical errors, it had logic errors, and the Code AI just ripped that apart. It was in the report itself. It was fantastic. So I don't know how a professional firm is going to keep going with the way that professional firms operate with this sort of tool available, this technology available. I mean, it's crazy. And how will professional fees be maintained at these crazy rates when I can take 30 hours of work and compress it into 45 minutes just because I know what I'm doing and the AI technology is that powerful? And how do you as a client, if you have somebody coming to you pretending to be a professional and just using AI, how do you tell the crap from the real stuff? That's also a big problem. I don't know what the answer to that is. It has to come down to brand at some point, I think. I think those with the brand are going to be trusted and those without a brand are going to be skeptical. We're seeing this already, if you think that's hypothetical, by the way. We're getting from clients and counterparties already, they're sending us legal documents, which quite clearly were not written by a lawyer. They were done by ChatGPT. They make no sense. And these people send it to us, and they did it themselves. They don't know what they're doing, and that's painfully obvious. And so this is going to become a real problem. And so I thought that was interesting as an experience this week. And I will tell you, well, I think we should also discuss, how do you value the mom and pop store down the road, the small business? What is the right methodology for that? I've told you many times on this show that value is forward-looking, is perspective. It is technically for every single business of any size. If I'm the buyer, the value of your business, the amount of money that I can put in my pocket after taxes in the future, the amount of money I can put in my pocket after taxes, discounted for risk and discounted for time. That is the theoretical definition of value. Hey, I'm Deep on Instagram. Thank you for joining us. That's the theoretical definition of value. But how does that apply to the mom and pop shop, to the garage, to the really small business? Because in most small businesses, in almost every small business, they're not generating enough earnings to do a discounted cash flow, to do an earnings approach to a valuation, to generate wealth. It doesn't work. And not only are they not making enough money for that definition of value, but the quality of the information is completely unreliable. As a purchaser, I'm getting notice to read their financial statements. They're incomplete. They're not counting their inventory on a regular basis, and therefore the margins are all off base. And so you don't have good information. You have not dealt with normalizing entries like we talked about before, real estate, occupancy costs, owner-manager compensation, these sorts of things. They have personal goodwill issues. What does that mean? We've talked about this on shows before. But personal goodwill means you're running a roofing company and it's Mary's roofing company, and I want to buy that roofing company. Well, Mary is the brand in her small community. Everybody trusts Mary to deal with the roof. They're not going to trust Scott to deal with the roof. So Mary can make more money with his business than Scott can make with his business. And that's what's called a personal goodwill discount. Key man discount is another way to say that. And it could be key person, sorry. And it could be 20%, 40% of what the value otherwise might be. And so there's all sorts of issues in these small businesses that you have to think about. And what almost always happens, not 100% of the time, but 98% of the time, what happens is the value of your business boils down to the value of your net assets. So it's not really cash flow future because you're not making enough cash flow in the future. You're making enough to pay a salary, maybe a good salary, but you're not making enough to generate value for me as a purchaser of your business, which means that your business is really worth the sum of your assets net of liabilities. Assets, cash, accounts receivable, inventory, equipment, less liabilities, maybe some small negotiated premium for the turnkey nature of your business. And that's it. Remember, all of my content, I tell you over and over again, is premised on the fact that 90% of businesses fail. 90% of new businesses started today will fail in the sense that they don't pay a living wage to their founder ever. 98% of them fail in the sense that they do not create intergenerational wealth. In other words, you can sell the business for value, which is what we're talking about today. So there's that 8% between 90 and 98 that you actually get a salary, you live a decent life, right? You can be a pillar of your community, pay your mortgage and all that sort of stuff, but you don't create any wealth out of that business. You've created a job, which is great. You have a bunch of freedom, you're running your own business, you get the risk and reward, but you're not creating wealth. And the reason you're not creating wealth is there's not enough profit, which means the value of your business comes down to net assets. And that's important to understand. And it's also why, by the way, we have a business course at thescottsinclair.com. You can go check that out, called the Pathway to Profit Academy. And it tells you how to earn more money, and it tells you how to value your business and how to position it for sale and realize on that wealth. Well, what else is going on this week? How are we on time? We're pretty good. We've been working with a manufacturing client. This is kind of the lesson learned of the week, where we're seeking an investment or a refinancing to take out the bank. So the bank is owed a certain amount of money. I'm not going to drop numbers on here because it's a live deal. They're owed a certain amount of money, and they have demanded, and there's a forbearance agreement, and they want to get taken out of this deal. And so we're out trying to find them new financing or raise equity money or sell to a strategic purchaser or something along those lines. And I'm reminded this week that it's really important, if you own a business, if you run a business and you're in that situation, you need to understand liquidation value of your assets. And you need to understand that liquidation value from a bank's perspective. Look, if you owe the bank $1 million, we're just going to make up numbers here, and you can get refinanced for $1 million and pay the bank out $1 million and go on with your lives and your business with a new lender for $1 million, great. That's what you're going to do. That should always be option number one. If you can't get $1 million because the economy is down, the cycle's down, there's a tariff war, whatever, you've gone through a series of losses, whatever the whatever the issues may be, you can't pay the bank out full. What do you do then? Well, now you're into negotiation. How much can you pay? How much will they accept? What is the bottom line? Where can I get to? Well, you need to, if you're going to enter into that negotiation, a critical piece of information is to think, what is the bank's bottom line? And their bottom line, and I'm going to assume in this statement that they're not angry with you, that everything's been above board, that there's been goodwill in the discussions and in the actions of the borrower, that there's no vendetta, there's nothing, there's no hostility built up with the lender, okay? But in the normal course, what is the bank's option? Worst case scenario, their option is to liquidate. To, in some jurisdictions, put in a receiver. In other jurisdictions, there's other ways to go about that, but the bottom line is they would liquidate the assets. And so you need to know, and the bank needs to know from a liquidation perspective, how much money would they get back by doing that? So if $1 million is owed, and again, we're just making up numbers, well, what if they could only get $300,000 net of professional fees if they liquidate the assets? So now the floor, why would they ever agree to anything less than 300 when they can go do that? They wouldn't. So your floor is 300, your max is the $1 million. You can't get the $1 million. And so now you have that delta, that $700,000 with which to negotiate. Personal guarantees and the value of those guarantees come into that discussion, but you need a starting point. And your starting point, if you can't pay them out in full, is you need to understand liquidation value. It is critical information. And so that is a reminder. That's a lesson learned. And the second thing related to that is a reminder that you don't just have to you're not just limited to going to another bank and having that other bank finance your bank, refinance the company and take out your bank. You're not limited to getting equity. You're not limited to a divestiture, to an equity sale of the company. Another transaction, which is kind of interesting, is to look at a purchase and sale of the bank's debt and security. I don't know if we've talked about that before on this channel, but very much a US model is the lenders have, and again, we're just using this notional $1 million idea. They have $1 million loan on their books, and it's worth $300,000 at liquidation value, and they don't believe they're going to get $1 million, but they could believe they do better than $300,000. Well, there's a whole market of other lenders, investors that would buy that debt from the bank. And so you would pay, say, $300,000, and the bank sells you that $1 million debt, and then the company owns the new group, still the $1 million, but the new group only paid $300,000 for it. Make sense? Okay, so that's a transaction that can happen too, less so in Canada. But I've talked to you on this content before about the acquisition of Navani Stainless is public information, so I can talk about that. This is one of the companies that was doing really, really well in our portfolio of owned businesses before I was off and sick and got screwed on that deal. But it's part of our recovery right now. So I've talked about it before on this channel. I've tried to be as open as possible. But the acquisition of that was exactly that. I had a business come to us that was in trouble, and the owner managers came to us and said, "Hey, Scott, can you get us financing? And by the way, I know it's 10 a.m., but the receiver's driving up the highway here, and can you get us the money by 2? And we need, I forget the number, say $3 million to take out the bank." I said, no, nobody's going to do that. There's too much wrong with your business, which is why you have been trying to, finance this thing for 6-9 months and you have failed. And there's nothing I'm going to do in a few hours. So that was depressing. And then I said, hey guys, listen, what is it you want most out of this? And what they said was, we want to be off of our personal guarantees. That's the biggest issue, right? One fellow was in his 80s. He didn't want to lose his house. I said, okay, here's what we'll do. Let's enter a deal right now, a term sheet right now. I will buy, Sinclair Range will buy the senior debt from the bank, the $3 million that you owe them. We will buy that, and the security that goes with it. And when we buy that, we will release you on your personal guarantees, and you give us the shares of the business for free. That's the trade. They said that would be awesome. So that's what we did. We entered a term sheet. I called up the bank. I said, I want to do this. They put the receiver on hold. And at the end of the day, we offered them 1.25 for the debt. I think that was the number. Don't hold me to that, but somewhere in that range. So 1.25, 1.5, something like that. So the business still owed us the $3 million, if that was the right number. But we paid the bank a discount. And then we released the owners on the personal guarantees, and they signed over the shares, and we owned the business, and we're the lender to the deal. That's a cool way to structure a deal. These guys were really unhappy with us. They threatened to sue. Their view was they didn't know that you could pay a bank less than it's owed and buy its debt and security. The truth of the matter is the bank is never going to do that for the owner manager that borrowed the money because they're angry with the owner manager that borrowed the money, but they'll do it for us because we're a secondary player, someone that wasn't involved in the mess, and we're just here writing a new check for new money. And that's a good way to get a deal done. Works on the buy side, can work on the sell side too. It's quick and easy. You can close quickly. And so that is something we're working on this week, and a lesson of the week. What else do we have here as we're 31 minutes into this? I want to talk to you about a golden rule of investing in assets. On anything, a business, an investment, it doesn't matter. You make your money on the buy. Remember that. There's your golden rule. Kevin Hawthor, good afternoon from Lakeland, Florida. Hey, Kevin, thanks for joining us. Where are you? You're on YouTube. Thanks for joining us. You make your money if you're investing, if you're buying businesses, if you're buying assets, real estate, I don't care what it is. You make your money on the buy. You don't make your money on the sell. You don't make your money on the value add. in between, you make your money on the buy. I'm not saying you shouldn't try to sell it for as much as you can. I'm not saying that you shouldn't be adding value in between the bid and the ask, the buying and the selling, but you make your money on the buy. That's where the margin is on everything. That's where the profit is. A little inside secret for you, a golden rule. That's where you make your money. I saw a social media clip by Charlie Munger and Buffett, Munger and Buffett talking about that. You make your money. He said, we've made all our money on the buy. That's the golden rule. I've told you guys about a printing packaging business we bought at Sinclair Range. This is a while ago now, but long story short, because we're dragging on in time here, but we bought the business for $1. Part of that is we had to refinance out the bank. I think it was $13 million at the time. So we did that with another lender, with OPM, other people's money on that. We got the shares for $1, and we operated the business 3-4 years. Sold the business, still owned the real estate, which came for the $1. Sold the real estate and ended up making, I think, $18 million on that trade with $1 investment. Now, we took some risk. We're signing on the hook. We're on the hook for it. But it was a $1 investment. It was an $18 million exit, somewhere in that range. And what's the point? The point is the sale for $18 million wasn't actually a great sale. We're arguing. We were negotiating for like 9 months. It was with a private equity fund. They're not going to overpay. That's not where we made our money. We didn't add much value. Yeah, we stabilized it. We recapitalized it. It was a better company than it was when we bought it. No doubt. We added some value, but we didn't add $18 million of value. The money was made on the buy. You always make your money on the buy. So let me ask you a question. If you accept that premise, that you make your money on the buy, then let me ask you, should you participate, if you want to buy an asset, in someone else's robust, competitive, fair market sale process? Is that the deal for you? No. I mean, that should be obvious. You are not going to get a great buy-side deal by participating in that process. What you want to do is you want to work on deals where you have a unique knowledge base. That is how you succeed. Something that is different from the rest of the marketplace of investors at large. You want a unique knowledge in that particular situation. I've talked to you many times about our debtor in possession loans that we've done in the last few months, maybe even longer, back to October. Sapphire Global in particular, but there's been other work on that. We're going into deals, first secured, high yield, and we're generating, completely safely over 50% annualized returns. If you go through the math, I can tell you that because it's public information in a court document. I've talked about it before. Okay, I don't say that in a bragging way. Nobody else would do the deal, and they wouldn't do the deal because they couldn't figure out the risk and how this works. But it's my world. It's the world of Sinclair Range. We have information. We have skill set arbitrage. We know what we're doing in that particular instance, not every instance, but in that instance we do, and we know how to structure it. Here's a little secret about that business that I always tell to lenders. No one comes to you and says, can I borrow your money at 50%? That's not a thing. That never happens. You need to understand the situation and be flexible enough to provide a solution. Not to think to yourself, well, these are the products I have. This is the type of deals I do. Does that fit that? No, that doesn't fit that. And then move on. If you want to get those sorts of returns, you're doing it based on a skill set and an information unfair advantage. You make your money on the buy. Think about it that way. All right, that's it for today. We're too long on this. Thank you all for joining us. Thank you for listening. Hey, are you a business in transition, going through high growth, going through distress? You need a turnaround. We're here to help you. Doing deals, we're here to help you. Reach out in the notes, give me a call, whatever you want to do, and we will talk to you hopefully next week. Hopefully it won't be another month until we do the next deal. Thanks for listening. We'll see you then.